Hello, everybody, and welcome back to another episode of the Rogue Agent Answers. My name is the Rogue Agent. Some people call me David Lewis, and every week I answer one of the many life insurance related questions that I've received from clients, from email subscribers on the daily email list, questions floated to me from across the interwebs, in the comments sections, which I know you're not supposed to read, or just interactions that I've had with people in real life over the past 20 years, which is a long time. And some of these questions I just scribbled down on scrap pieces of paper. Some of these are stuff I've written down on my phone. Some of it is on Post-it notes scattered all over the office. And every week I answer one of those questions. So if you'd like to ask your question, drop them in the comments section or join my email list for more life insurance tips and advice at Monegenics.com. Monegenics.com. And now for this week's question. Okay, this week's question is, how long do I have to make premium payments on my life insurance policy? My policy says it has a policy payment period of 65 years, but I only want to pay premiums for the next 20 years. Do I really have to pay premiums for the next 65 years? Okay, so the simple answer to this is no. You don't have to pay premiums for 65 years in most cases, although that depends on the policy design. So the policy payment period refers to how long you can pay premiums on your policy. If you do nothing but follow the guaranteed level premium payment schedule, then you will pay premiums for the entire policy payment period, which is, these days it's either age 100, and then sometimes some carriers stretch that out to age 120 or 121. However, you can also schedule premium payments over a fewer number of years. So a lot of carriers will have the option to design a policy where you're paying for a limited number of years. So even on a policy where the premium payment period is, let's say, 100 years, or out to age 100, let's say, there are carriers that will allow you to do something called premium offset, and what that does is it uses policy values to make the premium to make the guaranteed level premium payment. Another option would be to do what's called a reduced paid up policy conversion. So on a participating whole life policy, you have the ability to stop making premiums by contacting the insurance company saying, I want to switch this to, say, RPU, reduced paid up. And what the carrier will do is they'll take the current existing cash surrender value and they'll figure out how much death benefit that current cash value can buy forever, for the rest of your life, guaranteed. And then they will adjust that death benefit downwards until it reaches a point where that death benefit can be guaranteed forever. And then that's the reduced part. And then the paid up part is you don't make any more premium payments. No more money can go into the policy. And that's it. That's the reduced paid up option. Premium offset allows you to kind of turn off premiums for a little while and then turn them back on so you can make premium payments again out of pocket. This is a non-guaranteed option because it relies heavily on existing policy values, dividends being paid to the policy, and so on. In a universal life policy, you don't have a guaranteed level premium. You have a planned premium, and premiums can be turned off and on at will. So there is no ability to pay up, really. A universal life policy typically don't work that way unless it's a guaranteed UL, and even then sometimes it doesn't work that way. It could be like a guaranteed set premium payment period with a no lapse guarantee provision or no lapse guarantee rider attached to it. But most of the time you're not quote unquote paid in full on a UL just because that's just not how the product works. It's a planned premium. You can make it or you can skip it, and then as long as there's cash value in the policy and enough money to pay for the cost of insurance and other policy charges, you're fine. If there's not enough money or if charges exceed your available cash surrender value, your policy lapses. And that's it on a UL. On a whole life, it works totally different. You don't have to manage policy charges. You don't have to worry about whether or not there's enough cash surrender value for the most part. There's a guaranteed level premium, and as long as you make that guaranteed level premium, your policy stays in force. Now, if you borrow against the policy and you what they call overloaning, you borrow too much, then that's a situation where a whole life policy could lapse. But under, I'd say 99% of circumstances. You just make the guaranteed level premium and your policy is guaranteed to stay in force just because of the mechanics of the whole life policy and how it works. It won't lapse. So if you're working with an agent that does custom designs on these products, talking about whole life, universal life too, but for whole life, because that's where usually the premium payment period, that's that verbiage that applies to whole life. So if you're working with an agent that is customizing a policy for you, then you can specify, hey, I want to pay premiums for a certain number of years. Then I want to either use premium offset or RPU, and then I'm done. Or I want the flexibility to turn on RPU at a certain age, or not RPU, turn on the premium offset at a certain age. And some companies will have this baked into their software, so they do it automatically. On the back end, if you elect, hey, I want this thing to do on a premium offset after 10 years, they have automated software on the back end and the administration part of the policy management. It just automatically kicks over and will do it for you. And you don't have to do anything. Some carriers do that. Other carriers, you have to, when it's time, when you're ready, you have to fill out a form and submit it and so on to them. So, for example, you could schedule premiums to be paid for 20 years instead of, in this example, 65 years or 5 years, or you could have 10 years of scheduled payments, and then elect to reduce paid up, and it'll stop all future premium payment requirements and give you that paid in full policy. Or, like I said before, you could just do premium offset and do it where it would temporarily stop premiums. With that said, you should not be afraid to capitalize your policy with lots of premium dollars. Generally speaking, the more you pay, the better off you are. And so if it gives you more flexibility in the future, and so if you want the option to, stop and start premiums, quote unquote overfunding, using a paid up additions rider, paying more into the policy in the guaranteed level premium, that gives you more options in the future to lower premiums or stop premiums temporarily or do all kinds of different things with premium funding. So it's more flexible than just the straight whole life where all you have is just the guaranteed level premium and you can't stop making it. And so premiums always have to come out of pocket. A custom design gives you more options, more flexibility to kind of get around the guaranteed level premium requirements. And by the way, those are always going to be there on a whole life. There's always going to be a part of that policy that has a set guaranteed level premium. That's how whole life works. That's the reason why it works. With universal life, it's different. It's not going to work that way. It's a planned premium. There's no guarantees in a UL. It's all assumption driven. So I hope that helps, and keep those questions coming. I'll be back next week with answering another one of your questions. Thank you so much, and I'll see you on the next one.
Okay, that's it for this week's question. If you'd like to add your question to the list, just drop them in the comment section or send me an email. And if you want more life insurance tips and advice, just head on over to monogenics.com, monegeniix.com, and sign up for my daily email list.